You're logging into your 401k account on a random Tuesday night, the way you've done 100 times before. Same login screen, same blue and gray chart, same little pie graph that's supposed to make risk feel simple. Stocks over here, bonds over there. There's no warning banner, no email alert, no pop-up asking permission, just the quiet hum of your laptop fan and a login page that looks exactly like it did last year. There's no dramatic reveal, no siren. Nothing that tells you something underneath that pie chart has already started to shift. So how are you the last to know that the rules governing your retirement account just changed? The answer doesn't start with Wall Street greed, and it isn't a story about some shadowy hedge fund scheme either. It starts with a quiet regulatory shift, a battle over Department of Labor guidance, and asset managers rewriting who gets to take risks with your money. And it will permanently change how you look at that little pie chart the next time you log in. Let's start with what actually happened and when. For almost 50 years, there's been an invisible wall inside your 401k. On one side, stocks, bonds, index funds, things you can check the price of at 9:31 a.m. on any given morning. On the other side, private equity, private credit, and other alternative assets, the kind of investments that, until recently, only pension funds, university endowments, and people with 8 figures in a brokerage account were allowed to touch. You'd think that wall existed because those assets were simply too complicated for the average saver. But actually, the wall existed because of liability. Because for decades, plan sponsors were terrified that if they let something illiquid and hard to value into a 401k and it went wrong, they'd be the ones getting sued, not the fund manager who sold it to them. That wall is now being taken apart, piece by piece, after years of regulatory tug-of-war. Here's the first thing most headlines got wrong about this story. It isn't a sudden plan. It's a long-running chain reaction. The door originally cracked open when the Department of Labor issued a landmark information letter allowing plan fiduciaries to offer target date funds with a private equity component, while a subsequent administration issued a supplemental statement warning plan sponsors to exercise extreme caution, effectively freezing the market for 4 years. The financial industry never stopped pushing. Now, a massive regulatory push is underway to permanently clear the tracks for alternative investments in workplace retirement plans. That move reopens a door that the financial industry has been trying to kick down for a decade. And this is where the mystery deepens instead of resolving, because shifting guidance doesn't actually protect anyone. It just removes a warning sign. The people who manage your plan, your employer, your HR department, the plan administrator you've never met, still had every legal reason to be terrified of getting sued over it. So the real question isn't why the regulators opened the door. It's why plan sponsors would ever choose to walk through it.
But here's where it gets genuinely strange. Because the answer isn't the market demanded it. The answer is that the industry is aggressively lobbying for a legal shield. Asset managers and industry groups are pushing the Department of Labor for a formal safe harbor rule for any fiduciary selecting investments in a 401k plan. Strip away the legal language, and the goal is remarkably simple. If a plan sponsor documents a thoughtful process while evaluating an investment across factors like performance, fees, and liquidity, that process alone creates a legal presumption they acted prudently. Not the financial outcome, the paperwork. That is the piece that changes everything, because it means a plan sponsor could add a fund with private market exposure to your 401k. That fund can underperform, charge high fees, and be nearly impossible to sell. And as long as the sponsor followed the compliance checklist on the way in, they're largely shielded from the lawsuit that used to be their biggest fear. The first shift was regulatory. That alone wasn't enough to move a single dollar. The second shift is legal protection. And that's the one that actually unlocks the vault, because it removes the one thing standing between your employer and saying yes. And Wall Street didn't wait for the ink to dry. Major retirement platforms are actively evaluating partnerships with alternative asset giants like Apollo Global Management and Blackstone to build these products. Pioneer firms like Partners Group and Pantheon have already created collective investment trusts, or CITs, designed specifically to fold private equity and private credit directly into target date suites. Not a hedge fund pitching billionaires in a boardroom, a target date fund, the one selected for you by default, sitting quietly under your paycheck deduction. Here's what most of the coverage on this skips entirely.
what private equity actually costs you when things go sideways, and why it's structurally different from anything currently sitting in your 401k. When you own a stock index fund, you can see its price every second the market's open, and you can sell it before lunch if you want to. Private equity doesn't work that way by design. The underlying money typically gets locked up for years inside investments in companies that aren't publicly traded at all. There's no ticker, no live price, no button that says sell. Let me throw something at you that should be sitting in the back of your mind. How do you even know what a private equity holding in your 401k is worth on any given Tuesday? The honest answer is you don't. Not really. The fund itself estimates its own value on its own schedule, often just once a quarter, using assumptions the fund manager controls. Public markets are priced by millions of strangers trading against each other in real time. Private equity is priced, in large part, by the people who are also collecting the fees on it. And those fees are the second piece nobody puts on the label. Private equity has historically charged far more than the index funds most 401k savers are used to. A management fee just for holding it, plus a cut of the profits on top, layered on year after year. Then there's the structural risk. To protect you, regulators cap these private holdings at a small slice, usually 5 to 15% of a larger diversified fund, so the fund stays liquid. But even a small sliver introduces a massive mismatch. A 401k is built around the idea that if you lose your job or hit 59.5, you can pull your money out instantly. Private equity was never built for that. If a wave of people retire or get laid off in the same downturn, managing those opaque, illiquid slices at a massive scale with ordinary savers is a scenario that has never truly been tested.
None of this means private equity is a scam. It means the risk moved. Quietly, without a vote from you. For 50 years, institutions absorbed this complexity so individuals didn't have to. Now the complexity comes home, to your account, your retirement, your decision, whether you know it's a decision or not. So you're back at that login screen. Same blue and gray chart, same quiet hum of the laptop fan. Except now the pie chart doesn't look so simple. Somewhere in that plan document you've never opened, the one sitting in a folder called Plan Information, that you scrolled past when you got hired, there may eventually be a fund with private, alternative, or a target date attached to a collective investment trust utilizing these assets. The way to find out takes 10 minutes. Log into your plan provider's site, open the fund fact sheet for your target date fund or any fund with alternative in the name, and look for disclosures regarding illiquid assets, private markets, or valuation methods. If you see them, call your HR or plan administrator and ask 3 questions. What percentage of this fund is invested in private or alternative assets? What are the total layered fees compared to a standard index fund alternative? And what are the exact rules for getting my money out if the market takes a downturn? You didn't choose this shift. You inherited it from shifting regulatory guidance, a fierce legal battle over fiduciary liability, and a handful of the largest asset managers on earth who spent years waiting for exactly this door to open. The pie chart looks the same. What's underneath it doesn't have to stay a mystery.